As the President of CA Sri Lanka Kuwait Chapter, I warmly welcome the members of CA Sri Lanka Kuwait Chapter, members of other overseas chapters, and all other participants around the world who have joined today for this online event. I hope all of you are in good health and coping up the current situation. This is our second live webinar around COVID-19, which we believe highly relevant and a timely discussion. Now, without further ado, let me hand over the control to Tivaharan, who is an executive committee member, to take the session forward. Tivaharan, over to you.
Thank you very much, Mangala. Good evening, everyone. It's a great pleasure to meet you all again in a CPD event organized by CA Sri Lanka Kuwait Chapter. Before going to today's discussion, I would like to remind you a few guidelines. Please, everyone, ensure that you logged in mute and remain throughout the session. All the CA Sri Lanka members, please type your membership number and the name in the chat box to claim your CPD hours. If you have any questions, always welcome to raise your questions in the chat box at the end of the session. Question and answer session will be moderated by one of our ex-member, Dishani Malliya. COVID-19, the word that we are hearing for last 6 months, where we all scared, tired to live with this word. COVID-19 has dramatically impacted and changed the entire world, including the way business operated and day-to-day life of every human. Being a financial professional, it's our duty and responsibility to get to know how this COVID-19 may impact the financial report. So, back on financial report. It's my sincere Rasooldeen, who is a fellow member of CA Sri Lanka and currently servicing as a partner in Grand Thornton Kuwait. Also, is one of the past president of CA Sri Lanka Kuwait Chapter. Without taking much time, I am delighted to welcome today's resource person, Mr. Rizqi. Over to you.
Thank you, Tivaharan. Good afternoon, everybody, and peace and blessings be upon all of you all. And Aiban. Without ado, I will get to what our presentation is all about. My objective today is to give you all a high-level understanding of some, not all, of the potential financial reporting impact due to COVID-19. The slides itself give a lot of details, but I'll be basically, so you can have a look at it leisurely, but my objective is to give you a high-level understanding and bring out the key points and key issues. So I have 45 minutes, so let's start. So these are the topics which I'll be covering today. There are 5 main topics, so let's start. The first one is IAS 10 events after the reporting date. First, there is a small survey question which the committee has sort of put in time to organize it and do it in a nice manner. It's like a survey question. So if you could take a few seconds to answer, that would be great. Just click on it and then I think the survey will populate.
Yeah, done, Rizqi.
Okay, great. So, so we have a mix of 31st December year ends and some have 31st March year ends as well. Some August, some others. Okay. So you might be wondering why do we say, why are we starting with IAS 10, right? The first thing is we should know whether we should be adjusting our financial statements or not. So that's why we thought, okay, let's start with IAS 10 because that will basically tell you when to start adjusting, right? Or whether you should not be adjusting at all, right? So let's look at the principles. IAS 10 basically says, it talks about events after the reporting date. Events after the reporting date are events that occur between the end of the reporting period, be it 31st December, 31st March, and the date of authorization of the financial statements. And it can be adjusting or it can be non-adjusting. Let me just move this a little bit to the side. Yeah, okay. Right. So events after the report, what are adjusting events? events after the reporting period that provide evidence of conditions that existed at the reporting date. So for example, you have a debtor as of the reporting date, and subsequent to the reporting date, right, the debtor goes bankrupt. So that debtor was existing at the balance sheet date, and there were some difficulties, but the subsequent event basically confirms that the amount is not recoverable. So that is an example of a typical adjusting event. So that means you have to adjust the financial statements. Then there is non-adjusting events. That is events after the reporting period that are indicative of conditions that arose after the end of the reporting period. Typical examples which we all talk about is a fire which happens after the reporting date, a flood which happens after the reporting date, right? So those are events which are conditions that arose after the end of the reporting date. Accordingly, there is no adjustment to the financial statements, but they are only disclosed, right? And they are only disclosed if they are material. So what about COVID-19, right? What about 31st December 2019? That's the first question, right? And prior, if your year end is like August or September, or October or November, right? See, WHO declared the outbreak to be a public health emergency, international concern on 30th January. So that's when they basically declared it as an international concern. WHO declared it as a pandemic on 11th March. That was the day when they declared it as a pandemic. So in general, there's a broad consensus among firms and regulators that the impact of COVID-19 is generally a non-adjusting subsequent event for reporting periods ended on or before 31st December 2019. Meaning you don't have to do anything for financial statements as of 31st December 2019. Unless, of course, your company or your subsidiary is in China. Then you might have to think about it, because in China, maybe it was somewhere on during December. Even in China, basically the major impact was post, right? So that's something which you will have to think about. Consequently, okay, 1 second. Consequently, there would be no impact on the recognition and measurement of assets and liabilities in an entity's financial statements. So therefore, on 31st December, there is no impact. Unless, of course, such events call seriously into question the validity of the going concern assumption. If, of course, there is a concern on the going concern assumption, right, because of a subsequent event, then, of course, you will have to adjust. If, for example, your financial statements are no more going concern, right, your company is no more going concern, then in that case, you will have to adjust. That's an exception. So 31st December 9, 2019, it is only limited disclosures, right? If it has a significant impact, right? There are no adjustments required. So that would be the conclusion for 2019. So what about 2020, right? So what about 2019? When we said you have to do disclosures, what are the type of disclosures you're supposed to make, right? For material non-adjusting events, an entity must disclose a description of the nature of the event, right? And an estimate of the financial effect. Or if you cannot make an estimate, like in this case, because it's a evolving and a fluid situation, you might have to disclose saying that you are unable to make an estimate and the reasons thereof. So that is for 2019. So that's what you need to disclose. What are the examples, right? You might have certain management plans to deal with COVID-19. You might have breaches of covenants, waivers, or modifications. You might have significant declines in fair values, right? That might be an issue. You might have announced discontinuation of certain operations, and that's important for the readers to know, right? And you might be downsizing, right? So these are some examples of disclosures which you will have to make. So what about 2020 then? The answer is there is no universal flip point. It will depend on each and everybody's circumstances, right? But if you are treating it as a current period event requiring ongoing evaluation up to the date of the issuing of the financial statements, it will likely impact measurement and recognition across many areas of the financial statements. So if you decide it's a current period event, then it will impact your whole financial statements. Disclosure of judgments remain key. So let's see, what about 31st January to 2020? What about 29th February? If your year end was January, February, or March. In general, if it was January, right, is it an adjusting event? It's challenging because most of the things happened after 31st January. So chances are very likely that it is not an adjusting event, right? If it was February, then it is challenging to say not adjusting because it happened in February as well, right? So many entities may conclude as a current period event. That means you will have to adjust your financial statements for COVID impacts. If you take 31st March, the outbreak likely to be current period event, which requires ongoing evaluation for events after the reporting date. Because for sure, by 31st March, the outbreak had hit full-fledged and everybody was affected by 31st March. So if you have a 31st March year end, definitely, I saw some participants had 31st March year ends, then definitely it is a current period event and you would be required to assess the COVID-19 impact on your financial statements. Okay, I need to. All right. So what about 31st March quarter 2020, right? If you're talking about 31st March quarter 2020, we are talking about a year end of either December 2020 or maybe somewhere in March after March 2020. Definitely, it will be an adjusting event. So definitely, if you're talking about a quarterly reporting situation, right, it will be an adjusting event, and you will have to assess the impact of COVID-19 on your financial statements. So let's go to the next topic, going concern implications. Again, there's a small survey question to assess how GC impacts your companies. Please take a few seconds to answer. Okay, so basically 9% says there will be an impact, 55% which says no. That's very great. That's very good. This thing, and the remaining is yet to be assessed. So let's assess. Somebody. Okay, that's fine. Please mute your mics, or else everybody will hear your conversations. Okay, great. So let's move on. Okay, so going concern implications. Why is it important? How much attention do you need to be given on going concern for COVID-19? I mean, the answer is a considerable amount. Why? Because it's a very fluid situation which affects most entities across the board, right? There's unprecedented global economic impact, lockdowns and business closures. If you see in Kuwait, business have been closed for nearly 3 weeks, or maybe more than that. Restrictions on international travel. Kuwait's borders have been closed for a considerable time. Long-term impacts. Still, people are not sure how things will turn around, and maybe there can be second waves, and maybe there will be different impacts, and it is complicated. So we don't know what the long-term impacts are, right? So the financial statements are usually prepared on the assumption that the entity is a going concern. That's the primary basis of our accounting that everybody knows. IS1 places responsibility on assessing going concern on management at each reporting date. So whenever you're reporting, either quarterly or year-end, you are supposed to assess whether your company is a going concern, right? So that IS1 places the responsibility on Management should consider all available information about the future. So management should consider all available information. The period is at least, but not limited to, 12 months from the annual reporting date. So therefore, all subsequent events till issuance of financial statements need to be considered for the going concern, because management responsibility is for 12 months from the annual reporting date. That means if you're doing a 31st December 2019 year end, you are supposed to assess until 2020 December, right? There are a wide range of factors to be considered, such as current and expected profitability, debt repayment schedules, potential sources of replacement of financing, and so on and so forth. So let's look at some of the factors you should be considering. There are business factors, right? Like business model changes, how it impacts your going concern capability, supply chain impact. You might not have suppliers supplying anymore, significant staff absences, right? Where if certain areas in Kuwait are locked down, so maybe you cannot operate, right? Cash flow issues, right? These are some of the business impact factors which you should be looking at. Liquidity and solvency, right? Sources of cash flow. Maybe your revenue has dried up. What about government support? What about insurance, right? Loan covenant terms. Then restarting costs, fixed versus flexible costs, and feasibility of savings forecast. Because a lot of people do saving forecasts, right? That they can save this cost, but that should be feasible as well, right? Then of course you should be also looking at government support, right? Will the business be eligible to meet the conditions of the government for support? Like for example, in Kuwait you have support for SMEs, right? So whether you're eligible for those support is important, and the timing of support and the period covered, and if there are any repayment issues. So those are some of the factors which should be considering. So what needs to be done? What should you do? You should update operational forecast, definitely, because whatever operational forecast you had in the past may not be true because of the factors we talked about, right? And the risk factors and all might have changed. Your cash flow forecast must have changed. So you need to do a update of your operational forecast. Projected loan covenants, compliance, that's key, because some of your loan covenants which was in your agreements, right, may be based on NAV or based on profitability, right? And because of the present situation, there might be certain significant declines in your net asset values, significant decline in profitability, right? And there might be so many other impacts which will impact your loan covenants, and you have to project whether you are going to breach any of those loan covenants, right? If you end up breaching before you issue your financial state, before your reporting year end, right, most probably that will require reclassification of your loans to current, right? And it might have trigger other issues as well, and that might eventually trigger a going concern issue. So you need to see what are your loan covenants, and you need to start negotiating with your banks, right, to get some leeway on this loan covenant or an exemption on these loan covenants. What else? So then you will have to see what are the management plans to mitigate events or conditions that may cause significant doubt on going concern, right? And then, of course, you have to prepare and assess forecasted cash flow projections. That is key, because you need to see how you're going to meet your cash flows. And this is something everybody will be looking at, your cash flows. Banks, auditors, who want to see whether you have the capability of managing for the next year. And based on all this, right, on your assessment, you'll have to determine whether the going concern assumption, right, is appropriate or not. The key is consider all available information about the would be. So you're not impacted by COVID-19, or you are minimal impacted, right? Maybe because you're in the healthcare industry, maybe you're in the medicine supply industry, etc. No detailed disclosure may be required as a result. There is material uncertainty about, or your conclusion might be there is material uncertainty, but you have certain plans and management can mitigate those uncertainties. So in that case, what needs to be done? You have to disclose these in the financial statements, right? And you have to discuss what are these impacts and what is the management plan to address the uncertainty. So that would be required in your financial statements, where there is material uncertainty. The third is management concludes that the entity may be liquidated, or either it is by choice or it is because there is no realistic alternative but to do so because of legal issues, litigations, etc. The going concern assumption in that case, right, the going concern assumption would not be appropriate, and the financial statements will have to be prepared on another basis, right? Because you can't prepare your financial statements on a going concern basis, and that means it will impact all your assets and liabilities, right? Which may be such as liquidation basis, because then all your assets will have to be recognized on a liquidation basis. So those are the three conclusions for going concern. Right. Now let's look at impairment of assets, our third agenda for the day. Now, impairment of assets are covered under IAS 36, right? Now, what does IAS 36 say about record? The key is IAS 36 says, right, if there is any indication of impairment, right, you are eligible assets every year. But in our case, the most important what we should be looking at is IAS 36 says if you have indications of impairment, you have to do an impairment test. Now, in this situation, there are impairment indicators all over the place. So nobody can say there are no impairment indicators, right? So most probably you will have to do an impairment indicator starting Q1 or Q2, depending on the situation, right? Depending on how you're reporting, right? So what do you mean impairment indicators? These are some of the examples which are given by the standard. There are external indicators, then there are internal indicators, and there are certain dividends from investments which are mainly applicable to investments. External indicators, of course, the COVID-19, decline in asset values, significant changes in market, right? These are some of the external. Or internal indicators, physical damage, right? The change in use of asset, right? And of course, when it comes to dividends, right? If you're with regard to investment, if your net asset value in the investee is above your carrying value, right? If your net asset value of the investee is below your carrying value, right? Then that also would be an indication of impairment, right? So if there are indications of impairment, what do you need to do? That's the next question, right? So what the standard says is the carrying amount of, if the carrying amount of the asset is greater than the recordable amount, then you have an impairment loss, i.e. that means you need to assess the recordable amount, right? So for example, if you say your carrying amount is 90 and you assess your recordable amount as 80, right? That means your carrying amount is above the recordable amount by 10. So that means there is an impairment loss of 10. So that's the next step. So you have impairment indicators because of COVID. Therefore, you have to assess recordable amount. Now, what's recordable amount? What does the standard say? Recordable amount is the fair value less cost of disposal or value in use, two concepts, but the higher of it. Remember, it's the higher of it. It's not the lower of it, right? It's the higher of it, right? So now, for example, say you have a carrying value of 90, like we said before, and you have a fair value of 80 and a value in use of 100, right? Because it's the standard says higher of it, there is no impairment because the recordable value is equal to 100 and your carrying value is equal to 90. So since your recordable value is higher than your carrying value, there is no impairment. So that's the concept of how you need to look at it. So when you're looking at, now let's look at the first thing, recordable amount, fair value less cost of disposal. Now how that fair value is basically the price that would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. The key is between market participants at the measurement date. Now, because of COVID-19, things would have changed from year end. So if you're doing Q1 reporting, Q2 reporting, definitely by March, by June, things have significantly changed. And the price which everybody was willing to pay in December has significantly changed by March or by June, right? Because it says between market participants at the measurement date being whenever you're going to report, right? So definitely you will have to do a reassessment. For example, if your assessment in December was recordable value was based on fair value, right, less cost of disposal, you will have to reassess it, especially if the difference between the recordable amount and the fair value less cost to sell was a small gap. Then you will have to reassess and see whether there is reassess your recordable amount and see whether there is an impairment, right? What's value? Then we said the higher of either the fair value less cost of disposal or value in use. So what's value in use? Value in use is our normal DCF calculation, right? It's a discounted cash flow. So basically there are two main elements, right? Which is basically your cash flows and then your discount rates, right? Which you would discount. Now, how would COVID-19 impact? Definitely, you will have to reassess your cash flows, because whatever you had, your cash flows estimated in December is not going to be the same now, especially if that investee company is affected by, right, the COVID-19. Definitely, you will have to reassess your cash flows, especially if you have used value in use to justify that there is no impairment in December. So you have done December reporting and set, for example, say goodwill, and you have used value in use to justify the goodwill of a subsidiary, right? And if the gap was small, or if the gap was even, even plus or minus 10%, plus 10%, you still have to reassess cash flow, because maybe things have changed drastically now, and there might be impairments on goodwill as a result of COVID-19. Then the second factor you'll have to also reassess is the discount rate, right? You have to reassess applicable risk-free rates, because the risk-free rate which you built up your discount rate, right, would have changed. Of course, that might be possible. The risk-free rate might have gone down in the present situation, right? And then the risk with regard to the specific investment, the risk with regard to the specific country might have significantly increased because of COVID-19. So that also will have an impact. So basically, a discount rate might have changed in March or in June compared to what you reassess your value in use if you have used value in use as a do impairment test. Now, what are the type of assets which are covered under IAS 36, right? One of the assets which are covered under IAS 36 is goodwill, right? And what are those specific? The slide will tell you what are the specific indicators of impairment for goodwill. Like, if your goodwill basically related to subsidiary, if your subsidiary is performing bad, if your subsidiary is lost key employees, etc., then you will have to reassess your impairment with regard to goodwill, and you will have to do calculate the recordable value of goodwill, either based in value in use or based on fair value less cost to sell, whichever is higher. What are the other assets which are impacted? Investment in associates. It can be listed or unlisted, right? And these are some of the typical indicators of impairment. One of the main indicators being, right, disappearance of active markets, right? If it's listed, and decline in market value below your carrying value. If your market value is below your carrying value, then definitely you will have value in use. You will have to do a assessment of impairment, right? What other assets? Property, plant, and equipment, right? Maybe you're because of COVID-19, right? For example, or typical examples were like because of COVID-19, you're using the property, plant, and equipment for different use. Like some of the car manufacturers are using it to manufacture ventilators, or in Sri Lanka, some of the garment industry, they're using they are manufacturing masks instead of manufacturing clothes, so they're using for different purposes. Maybe these may be triggers of impairment. We don't know. They'll have to assess it, right? Then change in climates, businesses, cessation of business. Maybe that's an indication of impairment. And of course, if you have doubts about going concern of the entity, definitely it will have an impact on your PPE impairment. What else? IP at cost. If your investment properties are at cost, Definitely, we know that there is significant decline. There might be significant declines in rent income because of COVID-19. Chances are very high, right? Decline in occupancy rates, adverse economic factors which are impacting real estate market, which means that you will have to assess impairment of IP. Intangible assets, similar, like if your intangible assets have been adversely affected, like patents, rights, etc., and there is decline in from these assets, then definitely you'll have to test them for impairment. So those are some examples, right, of the type of assets which you will have to test for impairment as a result of COVID-19, right? So let's look at the next is IFRS 16, right? So again, there is a survey question to assess the extent of rent concessions. Please take a few seconds to answer. Okay, so it's 50-50, sort of 46 and 54. 46% are receiving rent concessions. So that's basically how the market is, right? Rent concessions are very popular in the current market, right? So IFRS 16 deals with rent concessions in a different way, right? Rent concessions are popular in the current market context, and it is an agreement between a lessee and a lessor to reduce rent or defer rent or to waive rent altogether. IFRS 16 has a concept called lease modifications, right? What is lease modification? It's a change in the scope of a lease or the consideration of a lease that was not part of the original terms, right? So it's either change in scope or change in consideration, which is not part of the original terms, right? So now, how do we link this rent concession and lease modifications? Based on the present standard, right? Rent concessions, in principle, it comes under lease modifications. So if you ask me how is rent concessions to be treated under IFRS 16, it is to be treated as lease modifications, right? So let's look at the present standard first. What does the present standard say, right? Based on the present standard, rent concessions, right? Now we are talking from a lessee's point of view, not the lessor's point of view, from the lessee's point of view, right? It can be either lease modification or it may not be a lease modification. If it is a lease modification, which is generally all rent concessions, right? Most of the rent concessions, it's the balance sheet approach. That means you recalculate your lease liability, right? And based on the recalculation of the lease liability, you compare that with your existing lease liability. The difference, you adjust your ROU asset, right? The recalculation is done based on the revised discount rate. Now, if it is not a lease modification, right, then there's an income statement approach. That means the difference between the two liabilities, you adjust, right? Whatever concession you get, right, you adjust to the P&L, right? And it might impact the P&L immediately. That's how the present standard works. If it's a lease modification, there is no impact on the P&L. But it will impact your future amortization of the ROU asset because you will adjust the ROU asset. But it is judgmental, right? And it is very difficult because you determining whether it's a lease modification or not a lease modification is not easy. And heavy workload for lessee, because a lessee might have, for example, maybe 100 leases. So for each of those 100 leases, he'll have to see whether it's a lease modification or whether it's not a lease modification, right? So as I said, based on the present standard rent concession, in principle, it comes under lease modifications. So what is the standard setters doing? What is the IASB board doing? The IASB board has introduced an amendment. It's an exposure draft. It was introduced in a very quick manner, right? And it is the verge of being finalized. I think maybe it will be finalized in this week or maybe in a couple of days, right? What does this exposure draft say, right? The IASB wants to make it simpler for lessees. Remember, they're not talking about lessors, they're talking about lessees. The amendment to the standard, what are they proposing? right, the lessee can choose not to go through the assessment process if the rent concessions meet certain conditions. So you don't need to assess whether it's a lease modification or not if the concession meets certain conditions. What are those conditions? Rent concession arises directly as a result of COVID-19. So you're getting the rent concession because of COVID-19, and the reduction effect on the payment is due before 30th June 2021. So if there's a rent concession given up to 2022 or 2023, that will not be covered. So it has to be reduction up to 2021, due before 2021, right? What's the second condition? The total amount payable under the lease is more or less same or reduces. So the lease total amount which is payable should be same or it should be less, right? It cannot be more, which is when compared to the previous amount, okay? So, and no other major changes to the lease agreement. So if these three conditions are met and you're getting just a pure rent concession, right, like a 3-month delay, 3-month free rent period, right, without any other changes, right, then you can use this option. So what's this option, right? What does the standard say? What is the standard proposing or the ISB proposing? It says, so rent concessions, you can either choose the option or you can choose not to do it as well, but be consistent. You cannot pick and choose for different leases, right? So either you use the option or you don't use the option, right? So if as a lessee you use the option, right, you account for the rent concession as if it's not a lease modification. Remember we said generally you have to assess whether any rent concession, is it a lease modification or not? But if you use the option, you don't have to do this. You directly, right, say it's not a lease modification and you impact your P&L. Most likely it's a day one impact. That means if you have immediately you'll have an impact on your P&L. But ISB is not very clear on that, right? They also are discussing and saying maybe it might be different for certain people depending on how the modification is done, right? But basically you're looking at a P&L impact within a short period, right? If you don't choose to use the option, right, and you want to make your life difficult, right, for whatever reasons, or if you have some other business reason, right, then you have to assess whether it is a lease modification, whether the rent concession comes as a lease modification or no. If you say no lease modification, of course, P&L impact. If you say it is a lease modification, right, then again, it's a balance sheet approach, right, which means that you will adjust your right of use asset by the difference in the liability. So that's what the exposure draft says, right? So it is not yet final, right? I think within a week it should be out. ISB is working on record speed time on this because it affects a lot of people, right? So a question to you is, if no,
it's a final risk. Yesterday it came at the final version. So
I did. Okay, so
yeah.
I didn't look at it yet, but I think so that if it's final, then it should be. I hope nothing has changed. I need to look at it.
Yeah, it's almost same. I didn't go through detail. It was
it's more or less the same.
It was same. Yeah.
Okay. Yeah. Okay. So that means ISB has set a record by doing it very, very fast, right? So I think it will be in line with this, and you can avail it accordingly. So that means the option is available right now. So if there is no rent in Q2, is there a gain in Q2? Yes, most probably yes, right? You will be booking a gain in Q2 as a lessee, yeah. Okay. Now, what are the other complications, right? Now, with regard to the rent, when you talk about lessee, the ROU asset, the right of use asset, which you have booked, right? What about depreciation? There are no specific guidelines yet it is under discussion, right? And maybe there might be some guidelines coming out, right? I'm not sure yet. But based on the present situation, if the modification, right, if there is no lease modification, or if you are using the exemption, which we talked about under the exposure draft, right? If lease term is not extended, that means you get a 3-month rent-free period and the lease term is same, right? That means you need to continue depreciating, because, for example, it is drawing from the PPE standard, right? You cannot wait without depreciating in that 3-month period. You have to depreciate, right? Because as for the property, plant and equipment or fixed asset standard, it says that any idle asset, right, whether even though the asset is idle, you still have to depreciate. So based on that concept, right, if the lease term is not extended, you'll have to depreciate. But what if the lease term is extended, meaning you get a 3-month rent-free period, but then they add on another 3 months to your rent-full contract, right? So drawing from logicality, right, you will have to stop depreciating within the 3 months. You can stop depreciating within that 3-month period, because logically you have acquired an additional right of use for an additional payment at the end of the lease. So you have a 3-month additional lease. So maybe you can think of stop depreciating, but you'll have to look at the terms and conditions, right? Then if it's a lease modification, like I said, if it's a modification, it's simple. Anyway, your liability will change and your right of use asset will change. And of course, when your right of use asset changes, right, the future depreciation on your asset will change, right? So that is if it's a lease modification. So that's about some issues which might come. Of course, if you're not depreciating, right, that may result in an impairment on the right of use asset, right? So that's the consequence if you're not depreciating. There might be an impairment trigger. Now let's look at lessor accounting. How does the lessor deal with it? Then now we talked about the lessee, right? The IASB has not proposed any exemptions for lessors. I think that's what I knew until a couple of days ago, right? The IASB has not proposed any exemptions for lessors, right? Because what the IASB, what is their view? They say that for the lessees it is difficult, but for lessors they're going to give the same contract for most of their lessees. So it can't be that complicated for lessees, right? So therefore they are not extending the extension of this option to the lessors. The lessors will have to follow the standard. So that means, what do the lessors have to do? They are required to continue to assess if the rent concessions are lease modifications, right? Thus, accounting will depend on whether the concession is a lease modification or not. So if it's a lease modification, we are talking about operating leases, because generally rent concessions are for operating leases, right? If it's a modification, if there is a lease modification, then typically recognition on a straight line basis. That means you'll have to spread the cost over the next future periods, right? And you will have to recognize as if it's a new lease. So you will basically, on the date of modification, you will have to take this lease as a new lease, and accordingly, right? Okay. Whose screen is that? Okay. Right. So you'll have to basically deal with it. It will impact your future, and accordingly, right? You will have to, it will impact your future and you will amortize accordingly. So there will be no impact on your P&L right now. Now, if it is not a lease modification, right, there is no specific guidance in IFRS 16, and you will have to deal with it case by case. Most probably, it will definitely lower your income because it's an expense, right? But you will have to match it with the asset. So maybe it can be an immediate impact to P&L, and you recognize the whole amount as an expense in the P&L, or maybe you spread it over. It depends on how you're treating the asset as well, right? That means whether it is classified as a cost model, or it's the investment property from which you're generating rental income. Is it at cost model or is it at fair value model? And depending on that, you might decide whether you can recognize immediately as an expense, or you spread it over the period. So again, there is no specific guidance on that, but you'll have to do case by case. So that's from a lessor point of view, right? But in principle, it's a lease. When there is a rent concession, it's a lease modification, right? Which we talked about. If it's a lease modification, the lessor will have to adjust, right, his future income. So it's not going, his expense is going to be spread over. It will not be immediate hit to the P&L. It will be spread over the lease contract period. Okay. All right. Now, Ecl implications. Now, what are the other concerns related to leases, right? Now, there might be Ecl implications. Why? Because tenant receivables, when tenants stop payments, right, there might be issues on impairment of the receivable itself, right? You might not be able to collect it. Revenue recognition, when tenants cease payments, right? You may not be able to recognize revenue, because if the tenant is ceasing payments and he's not paying you, can you keep on recognizing revenue? That's a question, right? Then there might be an issue with regard to past incentives which you have given, rent-free periods. Maybe you will not be able to recover them, right, going forward. Maybe that means you'll have to charge it to P&L immediately, right? Then, of course, there might be impact on fair value of investment properties because of all the rent concessions and decline in rents, etc. There might be an impact on the fair value of the investment properties. Of course, there can be also change, because sometimes you might have taken, when you're assessing your right of use asset on the right of use liability and the liability, lease liability in the past, you might have taken certain options of renewal into consideration. Now you might decide, no, I'm going to close it. Kalas, I don't want to have this outlet anymore because my business, I'm having problems because of COVID-19, right? So you might say, I'm going to close XYZ outlets because of this, and I'm not going to renew, right? But originally you had calculated your right of use asset and liability based on renewal. So in that case, you'll have to revise your liability and based on revised discount rates. So that means that also will have to be considered, right? So that's all about leases. I think I'm passing time. How many minutes do I have? 10 minutes, is it?
Yeah, we can take 10 minutes.
Yeah, okay, fine, great. Do you guys see lines in your screens?
Yes, we see.
Yes,
Yeah.
there are lines.
Okay, all right. I don't know what is that. Fine, I think that's another technical thing which you have to park it for now. Okay, let's start with IFRS 9, right? So what does IFRS 9 say, right? You all know IFRS 9 has basically, if you look at IFRS 9, there are 4 categories or 4 classifications of the financial assets. So basically financial assets can be classified into 4 categories, right? And based on those 4 categories, right, it is either at the measurement is either at cost, which is amortized cost, or it's at fair value, right? So you can see 3 types are at fair value and 1 is at amortized cost less impairment, right? So definitely that means all financial assets are going to be impacted because fair values have changed because of COVID-19. And of course, when you say amortized cost less impairment, there are indications of impairment, right? Most of the situations with regard to financial, because especially when you talk about receivables, there will be impairments. Especially you talk about investments, there will be decline in fair values. So what is fair value? Fair value is the price that will be received to sell an asset or pay to transfer liability in an ordinary transaction between market participants, measurement date, current market conditions. So definitely current market conditions are not favorable when you compare with December. So there are going to be impacts on financial assets, right? So that means everybody has financial assets. That means there is an impact. Okay. So let's take the types of listed. If you take listed shares, right? One thing which you need to consider is, right, though the current market price may not be indicative of the fair value, right? Because maybe there's a significant decrease in volume of activity, right? So as a result, those transactions which are there may not be orderly transactions. They might be forced transactions, right? Because they had to liquidate because of whatever reasons. So those prices which are in the market, which are shown, may not be the appropriate price for you to value your shares. So in that case, the standard allows, right, you can use other valuation techniques in combination with transaction price. So you sort of weight it and you use a combination of both, right? So that's one method. But of course, general principle is transaction price is always fair value, right? So this is an exception, right? And the next question you should ask is, a market participant who wants to buy these shares, will he be buying at the market price or will he be buying at a different price which is based on a different methodology? So that's the question you need to ask yourself. Then of course you have listed shares, then you have unlisted shares. Unlisted shares, again, if you're valuing based on market comparables, DCFs, all these might have been affected by COVID-19, right? So that means you will have to do a reassessment and see whether your investments are shown at the proper fair values, and you will have to do a valuation accordingly, right? So that's for unlisted shares. So now that's about fair value of shares, right? So what about ECLs, right? As per the standard, ECLs are required for all debt type financial assets, not measured at fair. So whatever which is debt type financial asset, not measured at fair value through P&L, ECLs are required, right? How do you provide for ECL? Based on information about past events, current conditions, and forecast of future economic conditions. So the second and third one, current conditions and future economic conditions, right? So as a result of COVID-19, what we thought of as of 31st December and what we thinking of right now as of May is totally different. So that means definitely there's an impact on ECL. So ECL is based on a 3-stage approach, which is stage 1, stage 2, and stage 3. So this is basically a recap of what ECL is, right? Which is a 3-stage approach, right? You have to consider all risks, right? I am going to skip this. So how do you measure ECL? ECL is measured by based on probability of default, exposure default, and loss given default. This is the formula which is used, and in different companies and banks and etc. it will be very complicated, right? But definitely the probability of default is affected by COVID-19, right? And also government support measures, right? So a positive fact is government support measures. COVID-19 business impact might also have an impact on probability of default. Exposure of default is affected by liquidity. Exposure default is what you expect a customer's balance would be at default, right? So that will be affected by the liquidity needs of the borrower. Loss given default is basically collateral values. Definitely collateral values because of COVID-19 has gone down. So that means there is an impact on loss given default. That means overall impact on ECL is there. So factors to consider: existing ECL models and methodologies may no longer hold, right? So normally ECL models use past days of overdue as important measure. Now it may not be, even though they were paying in the past on due time. Because of the present situation, their situation might be totally different, right? Just because you are giving them an extension on payment, it doesn't mean there's a significant increase in credit risk. You will have to assess value of collateral more frequently, right? So in general, there will be a greater probability of default across many borrowers, right? And a higher magnitude of loss given default due to possible decrease in value of collateral. So definitely the factors which come into which you consider during an ECL calculation, there is significant impact on those factors which will have an impact on ECL. That means when you're reporting for quarters in March, June, you will have to do a reassessment of your ECL calculations when compared to what you did in December, right? Regardless of what approach you use, whether it's simplified or whether it is a 3-stage approach, there will be an impact. The key thing with regard to trade receivables, right, is if you don't have any impact on ECL, right, you will have to be able to justify it, because generally, right, there will be an impact on ECL. Now that's about ECLs, right? Now when you're talking about debt moratoriums, which is very common these days, right? In Kuwait, for example, there's a 6 months debt moratorium, and you don't have the lender, the lenders have given a 6 months moratorium for the borrowers, and you don't at no extra cost. Now, how do you account for this, right? So the standard says any change in contractual cash flows of an existing financial asset or liability, now we are talking from both sides, borrower or lender, must be assessed. So a debt moratorium has to be assessed. How do you assess? The first question to ask is it substantial? Is the modification substantial, or is it non-substantial, right? If it is substantial, how do you determine whether it's substantial or non-substantial? Based on qualitative and quantitative factors. Quantitative meaning a 10% test. What do you mean by a 10% test? Compare the carrying value with the present value. Compare the present carrying. Say you have 1 million loan. Compare the carrying value of the 1 million with the present value of the revised cash flows of the discounted at the original effective interest rate. So you calculate the present value after the new repayment, right? And see what's the difference. Definitely it's going to be something lesser than 1 million. So if it is 975,000, the difference should not be more than 10%, right? If it is less than 10%, it is not substantial. If it is substantial, de-recognize existing liability and recognize new liability. If it is substantial, then interest is calculated new effective interest rate, all right? If it is not substantial, recognize a modification loss and adjust carrying amount via P&L to the present value of the modified cash flows, right? And you calculate interest at effective interest rate. So if it is not substantial, that means you will have to recognize a modification gain or loss immediately. That means there's an immediate impact on the P&L. If it is substantial, then there is no immediate impact to the P&L, right? The expense will be spread, the free period expense will be spread over the remaining loan period, right? So that's the impact. So what now in general, now the question to ask is debt moratorium in general, is it substantial or not, right? The consensus is, as per the IFRS, it is not substantial, right? That's what the standard says. But now if you look at Kuwait, right, Kuwait, this has an impact on the banks, right? And as a result, if it is determined as not substantial, all the banks will have to recognize a modification gain or loss, right, immediately, right, whenever they gave the concession, right? So central bank is looking at it. As you know, Kuwait central bank has the final say. So central bank will decide finally whether which route they're going to go, whether they're going to say, no, you cannot treat this as non-substantial, you will have to treat this as a new loan and accordingly affect future periods, or they might say, no, it is non-substantial, so therefore you should recognize the gain or loss immediately. So that is still under discussion. I spoke to one of our chapter members, Nandan, as well, and he said, yeah, the banks have not yet decided and the central bank is still contemplating. So that is still open. Just to give you an idea, right? A quick idea of which you can go through leisurely. I don't want to. If you take a 1 million loan, right, and you have a 1 year tenor and a rate of interest of 8% and a monthly installment of 86,000, right? This is how the original repayment schedule would be, where you would pay off everything in 12 months by 31st March 2021, and presume it is modified by giving a 6 months debt moratorium. And now your schedule shifts 6 months, right? Then what will happen, right? You will have a new effective interest rate. You can calculate that, right? Which will be going from 8% to 4.13 because the interest rate is going to come down. You have a new present value based on the existing effective interest rate, which is, if you calculate it, it will be around 960. So the new present value is 960 and the face carrying value is 1 million because our loan started on 31st March, right? So our carrying value is 1 million. So that means there is an immediate modification loss of 39,000. So like I said, there are two ways of calculating it, right? One is you determine it's a non-substantial change and therefore you book a modification loss, or you say it's a substantial change and therefore you don't book a modification loss. So this basically tells you what's the original schedule, and the second table is basically this, which is if it is non-substantial, right, then the interest rate is at the original, which is 8%, and the present value, you will start with the present value of 960 because immediately you'll be booking a loss of 39,000, and therefore your carrying value will go down from 1 million to 960, right? And you will be booking a loss, and then your interest will be at 8%. Accordingly, your total interest is 82,000. Your net interest will be, after the modification loss, 43. So at the end of the day, the net result over a period of 1 year will be the same, whether you decide it's a modification or non-modification. But the impact on the P&L is immediate if it's not a modification, and the impact on the P&L is spread. If you look at the last one, you will see we start with the principal of 1 million, but the effective interest rate is reduced. right, to 4.13, and you will calculate interest at a lower rate, and at the end of the day, you will reach 43,000, right, which is the net interest. So either in all three situations, the interest will be net will be same, right? Whereas in one case it will be spread, the loss will be spread. In one case, the loss will be hit immediately. So that is basically it, right? So these are some other areas which is not covered in the presentation, which may be impacted as a result of COVID-19, right? This is just for information for you to do some research on those areas. And that's it. I think I ran over a little bit as well. So over to you guys. Dishani?
Yeah. Thank you very much, Rizqi. It's a nice presentation and a very informative session. You took us through some of very critical aspects. Event after reporting period, going concern, impact on leases, impact on financial instruments, impairment of assets. These are very practical situations for this audience. No need to mention that our participants were truly benefited. Now we can move to the Q&A session. Members and other attendees, you may type your questions in the chat section now. Actually, we already have a couple of questions, so I will start with our first question. Do we need to do any adjustment or disclosures if we receive any concessions from banks, such as reduced interest rate, differing installment, etc.?
Yeah, you will have to, like I said in the last slide, you will have to see when you receive the concession, right, and what are those concessions, and accordingly you'll have to do the accounting, depending on whether it's a substantial change or non-substantial. If it is non-substantial, which is generally would be the case, right, then you will have to immediate gain in the P&L, and you will have to calculate it based on IFRS 9. You have to do the calculation, and there will be a gain, right?
The next question.
But like I said, CBK is still on this with regard to Kuwait, right? So we'll have to see what CBK comes out with for the banks. And then if they come out with something for the banks, they might say, okay, for the borrowers, I don't know whether they're going to touch the borrowers, but definitely they will influence the lenders. Yeah.
Okay. The next question is, if the recent concession is only for a couple of months, will it be a lease modification?
Yes, it would be, even if it's 3 months. But then again, like I said, even if it's 3 months, if you look at the examples which is given, even if it is 3 months, it is a concession, right? Because it was not planned in the original contract. So therefore, it will be a concession. But then you have the option, right? You can treat it under the option, and you don't have to assess whether it's a concession or not, and you can directly take it to P&L, unless you, of course, want to go through the model and determine whether it's a concession or not, right? But yes, it is a concession.
Next question. If we use the extension of not to modify, what shall be done for the interest expenses coming from lease liability?
Again, if you use the extension of, what do you mean not to modify?
If we use the extension of not to modify, what shall be done for the interest expenses coming from lease liability?
Okay, I presume he's talking about whether you should be charging interest during the 3 month period or 6 months period whenever there is a concession, right?
Yes.
That's what I'm presuming, Yani, right? Yes, there is nothing clear in the standard, but there are some guidances here and there. So you will have to charge interest even during the concession period, not like the depreciation of the ROU, right? You will have to charge interest over on during that period on the lease liability. But your lease liability will depend on whether it's whether it has been adjusted by the concession or not, depending on whether it's lease modification or not. Yeah.
The next question is, how these lease concessions can impact to sublease arrangements? We were previously using square feet basis computation.
To be honest, I have not looked at sublease. So I wouldn't want to commit on that. So I'm sorry, Annie, but I have not looked at the sublease part of it.
No problem.
But I suppose the concepts are same, so you could draw from that. But I would need to look at it, yeah, to be honest.
Yes, no problem. For listed bonds, do we need to assess ECL or fair value will be sufficient?
It depends on what was your model. If your model was fair value through P&L, right, then there is no need for impairment. So like I said, ECL is not required for assets which are fair value through P&L. But if it is fair value through OCI, right, that means fair value through OCI means you are parking your changes in fair value in OCI. That means there is a requirement of impairment. Whenever debt instruments are classified as fair value through OCI, there's a requirement for impairment. So therefore, that means you will have to assess any impairments and transfer to P&L. So in that sense, you might have to see what is your listed bonds fair value, right, and accordingly transfer something to P&L as an impairment provision based on the fair value. Now, if a listed bond, if it was at amortized cost, then that's different. Then you might have to, so listed bond can be classified in two places. One is amortized cost or fair value through OCI, depending on your business objective. If it is at amortized cost, definitely you have to do ECL, right? But if it is fair value through OCI, then you will have to transfer impairment to P&L, either way. Yeah.
Okay. So I will take our final question. What about the government concession on interest and other proposed Kuwaiti salaries refunds?
The government, I think if you look at my slides, that was one thing, which is government grants, right? When there are government grants, which is not, we didn't cover that actually, which is when there are government grants, it depends on the conditions and etc. And you'll have to match it with the expense. So if you're receiving a government grant for Kuwaiti salaries, then you'll have to match it with the salary expense, right? And amortize it over whatever the condition of the government is. Maybe they might say it's a 1 month condition, they might say over a period, depending on whatever the grant is given for and whatever term it is given for, then you might. So it all depends. If it might be a one-time government grant for whatever reason, and then you might recognize it immediate income, or it might be for future expenses over a period of 6 months. Then you'll have to amortize the government grant over 6 months. And the same goes for interest concessions as well. If you might have to match the expense with the income, right? So you will match both. So if you are recognizing the income one shot, then the expense also, sorry, the expense in one shot, the income also will have to be recognized at the same time.
Okay. With that, this session comes to end. We would like to get your valuable feedback on this session, and we have arranged an online feedback for that. You will shortly see a feedback form on the chat section. Please take a minute to give your feedback on the session. I must mention our deep sense of appreciation for the speaker, Mr. Mohammed Rizqi Rasooldeen, partner Grant Thornton Kuwait, for accepting the request of Expo and making a valuable session. Irrespective of your busy schedule and other commitments, you humbly accepted our request without any hesitation. Once again, thanks a lot, Rizqi. I would like to thank our Kuwait chapter members for your active participation as always. And I would like to extend our special thanks to all other CA chapters in GCC region for accepting our request and participating in this session. Finally, I would like to thank all other participants for your enthusiastic participation made this event a success. And last but not least, our Exco members for arranging this session. Once again, another reminder on the feedback. Be safe, have a great evening. Thank you all.